Congratulations! You found the Sandu Pirls Stock Market Commentary for September 7th, 2015. Market breadth. With this past week's market decline, our bull-bear point and figure ratio fell from 0.78 to 0.50, declining further into bearish territory. The total count of securities in bullish or bearish patterns fell 14% to 2,769. The count of bearish stocks increased 2%, while the count of stocks in bullish patterns decreased 36%. The Sandu Pirls P&F Market Breadth Summary Chart shows us a market now 15 consecutive weeks in bearish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 61 points for the 13th advance in 31 weeks. At a negative 794.90 points, it continues below all 8 tops above plus 100 and continues below 4 of the 5 bottoms below minus 100 in the last 3 years and has risen above the newly formed August 2015 bottom. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. The Woody's CCI 20 daily in a Woody's downtrend, now at 65.82, continues outside the plus or minus 50 range required for a zero-line reject short entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 59 weeks ago, while the daily CCI 20 began a Woody's downtrend 3 weeks ago. The CCI 20 weekly rose to minus 223.07 from last week's minus 333.37 and now has 4 consecutive weeks below zero. Industry rotation, the last 2 weeks, all of the top 5 industries are positive and 4 of the bottom 5 are negative. Bullish semis has entered the top 5. Gold and silver has entered the bottom 5. Brokers and KBW Bank have left the bottom 5. Bearish REITs has entered the bottom 5. Oil services continues to lead the top 5. Oil has entered the top 5. S&P retail and computer hardware have left the top 5. Focus this week from www.bullionstar.com by Kuz Janssen, The Concept of Money and the Money Illusion. This might be the clearest article we've yet read explaining how the illusion of today's monetary system works. Did you know that when you give your money to the bank, it is no longer legally yours. This and other key points follow below. Awareness about the concept of money is making a comeback. Gone are the decades in which the global citizenry was fooled to leave the subject to economists, governments, and banks, a setup that has proven to end in disaster. The crisis in 2008 has spawned debate about what money is, where it comes from, and where it should come from. This is how money came into existence. The orange farmer decided to exchange his product for a highly marketable commodity. A bag of salt, for example, could be preserved longer than oranges and was divisible in small parts. Money is supposed to serve three main purposes. 1, a medium of exchange. 2, a store of value. 3, a unit of account. The boost money has given to global wealth is beyond comprehension. The concept of money has been an indispensable discovery of civilization. We must realize the subject of money is always a matter of trust, because money in itself has no use value for us humans. Commodity money, like precious metals, does have some use value, which it derives from its industrial applications. The majority of commodity money's exchange value is based on its monetary applications. The residual is based on its industrial applications, use value. If a commodity is abandoned from being used as money, the monetary value leaves, and what is left is the use value. The exchange value of money equals the amount of goods and services it can be traded for at any given moment, popularly called its purchasing power. After commodity money came fiat money. The nature of the latter is fundamentally different. From Wikipedia, fiat money is currency which derives its value from government regulation or law. The term derives from the Latin fiat, let it be done, or it shall be. Both commodity money and fiat money can be used for fractional reserve banking. In 1848, a Supreme Court in the United Kingdom ruled, money, when paid into a bank, ceases altogether to be the money of the principal. It is then the money of the banker, who is bound to an equivalent by paying a similar sum to that deposited with him when he is asked for it. The money placed in the custody of a banker is, to all intents and purposes, the money of the banker, to do with it as he pleases. He is guilty of no breach of trust in employing it. He is not answerable to the principal if he puts it into jeopardy, if he engages in a hazardous speculation. He is not bound to keep it or deal with it as the property of his principal. But he is, of course, answerable for the amount, because he has contracted, having received that money, to repay to the principal, when demanded, a sum equivalent to that paid into his hands. Guess what? Your money at the bank is not your money. A bank deposit is a loan to the bank, which should justify the fact banks only have a fraction of outstanding liabilities or receipts in reserve. Sand to Pearls comment: can English and American banking laws be much different on this point? Banking thrives on the presumption not all money will be withdrawn from a bank at once. That is, until that happens. Millions of banks have gone bust in the past, and many will in the future. The bait for fractional reserve banking is, of course, interest. Why do you receive interest on a bank deposit? Basically, because you lend your money to the bank and receive interest for the risk of losing it. The golden rule is no risk, no return. The most intriguing fact is that credit simply doesn't exist. Credit is created through an accounting trick. If more than a fraction of all bank customers want to withdraw their money, it's just not there. Credit only exists as book entries and in our minds. If customers have 1 million euros deposited at a bank in total, they think they truly own that money, whereas in reality, there is only a fraction of the 1 million euros held by the bank in reserves. Yet, every financial decision they make is based upon the amount of money they think they own. The lion's share of their money only exists in their minds. This is what I call the money illusion, in which most of us on this planet are submerged. Will we ever awaken from this dream? And will the real value of money and credit be exposed? Thank you for tuning in for this week's Sand to Pearls Stock Market Commentary, featuring the proprietary Bull-Bear Point and Figure Ratio Market Breadth Summary Chart, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful, pleasant, and restful Labor Day weekend, that you are looking forward to a great week coming up, at least it will be a short one, and wishing you true success.